I know. You're probably thinking, whoa, player. I thought you said life insurance was tax-free. Life insurance is tax-free as long as you follow the rules. You can still create what's called a taxable event if you don't follow the rules. What's up, family? This is Justin Smith, and on today's episode, we're going to talk about why or how you could possibly have to pay taxes when it comes to life insurance. Lock in. Let's talk about the 3 taxable events. First event is called a MEC, which is a modified endowment contract. This is a guideline limit that the IRS sets on us to make sure that we don't take advantage of them by turning this insurance policy into an investment. This is their way of stepping in, making sure we don't have too much cash value compared to life insurance, because it is life insurance first. This is because back in the 80s, when interest rates were better than today, the wealthy would take advantage by putting all their assets or money into these life insurance policies because of the tax-free advantages. So they were dumping big money in there and asking for the smallest death benefits possible. Then, of course, the government came back and said, wait a minute. You can't do that, because in order for it to be life insurance, there must be a risk. Because if not, you can get a really small life insurance policy or death benefit, max funded, and the life insurance company will have no risk. So then the government decided to smack the wealthy on the wrist a couple of times back then, and they made a few changes of what is now what it is today. Now, even though you have a taxable MEC, you can still transfer that death benefit to your family tax-free. But you do want to make sure you work closely with your agent or your advisor when it comes to creating these policies so you don't get a MEC. The second event is if you cancel the policy. Speaking of whole life in particular, the policy is for your whole life. So if you cancel the policy, you're taking away from the actual meaning. All that tax-free growth that you had in the policy will be lost if you cancel the policy. A few things that could happen here. For starters, you will be taxed. Secondly, you will be penalized for cancellation. This is for surrender charges to be exact, meaning if the policy is around or even less than 10 years. Even if you pull out your money before 59 or you cancel your policy before 59 and a half, you'll get another 10% penalty. This is why when you get a permanent policy, you want to get something that you can afford. This is also why I love the flexibility of the IUL. Now, the third and final taxable event is when your policy, or if your policy lapses. This means you just decide to stop and have no obligations to paying that premium. It can also lapse if you take a loan out too soon to the point where the policy cannot pay for itself. So the lapse means a policy is not mature or there's not enough money in the policy to fund itself. Meaning instead of canceling the policy, you just stop paying it. So if it does lapse and you have cash value in there, that cash value will be taxed. Also, say bye-bye to the tax-free advantages and the tax-free growth if you do this as well. This is just a quick example of what can happen, or the 3 taxable events when it comes to life insurance. My name is Justin Smith, and we'll see you next episode. Peace.